Hi folks, this is Sean Hyman again, and I want to talk to you today in the chart of the day about a bullish inverse head and shoulders pattern. And what this is a technical pattern where you have a low that forms, a lower low that forms, and then a higher low that forms, and that's the key. The market cannot push it down into another lower low, and that's what makes the pattern bullish. So the sellers were in control, the sellers were in control. This is the first point where it appears that the sellers are not in control. A higher low rather is produced. What you're looking to do is see if it can produce a higher high and take out these highs. If it can close above what's called the neckline here, which is this right here, this black line, and hold some candles above it, then there's a huge chance that the pattern has completed and is validated. If so, you can take a projection from the bottom of the head all the way up to the top, because remember, it's like this person's flipped upside down, inverse head and shoulders pattern. So you take from the bottom, draw a vertical line directly up to the neckline, take that same measurement, you move it over here to where the breakout is, the breakout point, and it gives you a minimum price target. Now, which is around 146. This minimum price target also happens to coincide with a larger downtrend line here, so it makes 146 to be fairly formidable resistance. It's very common for these patterns to break out, pull back to their neckline, and then launch forward. So here is our line in the sand that we're at right now. Let me see if I can zoom in on this a little bit here. We're literally at the neckline right now as I'm taping this. And so it's a high probability that this pair will rocket forward and eventually work its way as it zigzags up and down over the upcoming days to week or so up to the 146 level. However, here's what I like about the head and shoulders pattern. If it does not validate and complete by holding above the neckline, say it starts to trade way back down here, great. Then the downtrend is still in force. You can short it, and you'll see it typically come back down and make new lows, or at least equal lows to the former lows. So it's a good line in the sand. It gives you a distinctive place on the chart, and that's what I like in trading. Really something that helps you have a deciding factor. So if we decisively hold above the neckline, we should head upwards to 146, which is a few hundred pips or so from where we sit now, actually about 325 pips as of the current pricing. Or if it closes and holds below the neckline, then we could short it and head down. Again, if the pattern holds, so it's a bullish pattern, it pops out, it goes back to the neckline, which when it pulls back to the neckline is actually one of your higher probability entry points to buy, and then it heads north up to the price projection, which is here up towards the major line, the major downtrend line. This is definitely something that I talk about a lot in our global currency cross service. I use a lot of price patterns that have targets and price rejections because it gives us confidence to stay in the trade. So that is the lesson for the chart of the day today. Thanks so much for attending. Bye-bye.